That warns. That is a dangerous exchange for physical divergence.
The new and improved, you can tell, Andy, 2022 is going to be a massive year for everyone, and we welcome everyone. So, Andrew, let's, as we usually start with a review, there's a lot that's gone on over the last little while, and let's maybe give everyone an update of what's happened since our last episode in 2021.
I know, and it seems like a million years ago. I mean, this is a fast-moving marketplace, but of course, we've got a lot of stuff to cover. And we'll cover it as quick as possible. But yeah, Shane, a good place to start is always with the summary of the action that we've observed, and I think we need to look at the action we'll look at first at this action in the first shortened session of New Year, which was last week, amazingly or not. And that commenced. It's important to note that because there were a lot of people upset about the action. Hey, London was closed on that day, on the 3rd. And then, of course, we'll look at the action through non-farm payrolls. And then we're entering the first full week of 2022 trading. And with a focus, of course, as yet, on the unrealized Basel III NSFRs, which are slowly removing paper market hedging liquidity for COMEX shorts. Now, we're going to look at that in a minute. But let's start by summing up, because this is, I know, so many questions. People want to look at the action. They want to connect the dots. Why has it made sense? What has been the progress? So if we start by summing up this very rangy action, and if you look at it, it's actually not that volatile. But, you know, people sort of get upset whenever we see any kind of selling, but we'll look through that. We're looking at the first 8 trading days. We're recording this on Wednesday. This is the 8th trading day. And we'll look at why really we should expect, and why we should expect higher gold and silver prices into the first quarter. So the COMEX-centric bearish session that commenced on the 3rd of January, which was the Monday, impacted a gold and silver market which really lacked both LBMA gold and silver fixes, which the physical market, of course, requires to benchmark wholesale gold and silver prices to. So this was a 100% COMEX-centric action, but what it did was provide us a perfect example of where the gold and silver market selling emanates from. And it really highlights this is how synthetic in nature this action is. Of course, that was that little window when the market, when the fixes weren't there and the wholesale market was essentially closed. Now, COMEX speculators are really blinkered to any view of the underpinning physical market strength, and they were led by the nose in that session by the market making insiders, pulling bids into an illiquid, really a liquid market at this point. And so what they did was begin exercising old muscle memory, into inversely correlated rising bond yield inputs. Now, if we talked about this before, how these base algos, it's a 95, 98% algo driven market. So if we see a rising bond yield, we see an inversely correlated spec program that sells silver, sells gold into a rising bond yield. So, I mean, so this old muscle memory, they've got no view into the physical market underpinning this. And of course, what that did was immediately we see what they did was essentially sell gold from the top of this range. We're talking about this rangy sort of area between 1800 and 1830. So they sold it from the top of the 1830 range, and that's an options range that we talked about in our previous episode, right to the bottom of that range. And so, but with insiders exposed to the physical market, and we'll talk about that in a minute, they were 1-to-1 long against these speculators. And the deliberately delayed COT report, which of course a lot of people look at, study this COT report, it shows, who was, what category of trader was long or short, etc. It really captured a fraction of this action where the commercials were going long against the speculators. And so the spec-driven bearish price action was followed the next day on the 4th, which is when we joined the market. It was the first full liquid session of the year. It's good to connect these dots because, it's easy to say one thing and then not understand where we came from to understand where we're going. So what happened? That was the first time we had a strong physical buying, came in benchmarking the first gold and silver fixes of 2022. Pretty close to where they closed, but higher than where they closed in 2021. Now, the physical market, along with the market-making COMEX commercials, these are the market-making commercials on the COMEX, they jumped on, and the physical market jumped on the paper-induced discount, driving gold futures right back to the top of the 1830 range the very next day. 100%, that was, but here's the important point, 100% driven by very strong physical buying. Now, it was quite evident from discussion with our liquidity providers as we started trading on the 4th of January, because obviously we want to find out where are the liquidity, where is the paper price versus the physical price, so that gives us an idea of what to expect and who's going to be buying or selling where. And so what we found was that the COMEX-centric commercials were definitely reluctant to add any shorts that they couldn't back up with a legitimate, fully backed, over-the-counter position that will ultimately lead to stronger prices. And again, we'll drill down into that in a little while. But this beggars the question, where was the selling coming from then? So specs trading, a 100% cash settled futures market, are really conditioned to thinking that chasing a dot on a screen from infinite to zero in a cash settled non-delivery market is a viable trading option. I mean, that's unbelievable. But this is a strategy which is clearly in play. And this is because they don't have any visibility into the physical supply-demand fundamentals underpinning the gold and silver market, nor is it on their radar that Basel III regulations will significantly reduce the paper-driven tailwinds that they are psychologically psyoped into believing and thinking. Now, the resulting self-fulfilling chart-baited historical trend lines, the moving averages, the paper-centric pivot points, have historically led these speculators into becoming patsies to periodic, insider-driven, led by the nose, self-ignited, sell the rally market waterfalls. Now, these are easy to generate if you've borrowed money off the house. And this is where the banks bankrolling specs who've borrowed these leveraged positions off them rig these paper traders into a position where they can call these loans in at a profit, simply. We've been through this multiple times.